Hello, I'm Bernard Hickey from interest.co.nz and welcome to the Investing Report, where today we report news just in that Geneva Finance has received a reprieve from its debenture holders. It now won't be put into receivership. Earlier today at the Ellerslie Convention Centre in Auckland, debenture holders and note holders met to consider a plan to restructure Geneva's balance sheet, essentially to pump in a bunch more equity. You might remember Geneva's been in a debt moratorium since November last year, where it wouldn't repay debentures as they came due, but continued to make interest payments. Now it pledged then to cut costs, to build up its cash pile, and to look for new investors. Now it built up its cash pile and it did cut costs, but it couldn't find a new investor, and has instead come back to its debenture holders and its note holders and said, we need an equity injection, so could you just swap 15% or so of your debentures for shares in Geneva, which will be traded on the NZ Stock Exchange? Now, debenture holders essentially had a choice here. They could either choose the plan put forward by Geneva, or they could go for a receivership. An independent report said that if they stuck with the Geneva plan, investors would get back about $1.15 for every dollar they'd put in over the next 4.5 years, whereas a receivership, they'd get back around 90 cents in every dollar over just 3 years. Another option that wasn't mentioned at the meeting was the potential immediate sale of the loan book for Geneva to Bluestone Group, and in return debenture holders would get about 85 cents in the dollar. Now Geneva chose not to put that to the meeting. It said it wasn't a solid enough bid, and also it couldn't be done in time for the meeting. In the end, it doesn't matter now because Geneva Finance's debenture holders have voted 94% in favour of the restructuring plan. Geneva presented its case to its debenture holders and said it had cleaned up its act, it realised it had made mistakes, it had tightened its lending criteria, restructured its bank finances, and it could survive for several years without debenture funding and continue lending. There are challenges around though for Geneva. The economy is slowing and the default rates on the consumer lending that it does are likely to rise, although Geneva is forecasting they'll actually fall over the next couple of years to 4% from 12% a couple of years ago. Remember, Geneva lends most of its money to people who are looking to buy couches and go on a holiday or pay for a wedding or whatever. We're talking relatively small amounts to people who can't get money from banks. So the economy is slowing. That will be a challenge for Geneva. But the other one is a problem with getting wholesale funding. Remember, Geneva's model until now has been to borrow money from mums and dads in the debenture market. That market is pretty much shut down for anyone except those with an investment grade credit rating or who have diversified funding sources. Geneva had neither of those. So Geneva will now need to find some money from the wholesale market. It will have to securitise some of its loans and sell those on to wholesale investors. Trouble is, that market is shut down too at the moment. Geneva is betting that in the next couple of years things will calm down a bit and it will be able to go back to the wholesale markets. It's also still dependent on the Bank of Scotland, who's lent it quite a bit of money. We'll see how this all turns out. For now, Geneva Finance debenture holders have voted in favour of the plan and no doubt are hoping that over the next 4 years they'll receive most of their money back. I'm Bernard Hickey from interest.co.nz. That was the Investing Report.